Good morning. This is Ken Long from Tortoise Capital Management with a review of two of our favorite indicators. One, Williams percent R, an oscillator for overbought or oversold, and we're going to compare that to our own Tortoise NDX, or the Tortoise Index. This is one of a series of examinations of some technical indicators. So we're going to look at percent R versus the NDX. This is a view of a page in our daily report set. Looks at the Dow 30, called the Tactical Summary, and it pulls together a lot of different signals that we use as a way to start building our trading plan. On the left-hand side of the screen, just for reference, we have a bunch of our swing trade patterns. We have what we call the auto framer reward to risk ratio, which is a standard way of computing opportunities versus the risk. And we're looking at the 30 symbols of the Dow 30 industrials here. Those that are highlighted in red are ones that were exceptional percent losers the previous trading day. Those in green were percent winners. We have a reading on the RSI2 value. We care about that indicator, and we'll do a separate presentation on that. The next section, we're looking at the percent that the symbol has changed over an assortment of look-back periods. So we look back 1 day, 10 days, 1 month, 3 months, 6 months, and 12 months. And this is what the net return has been over each of those look-back periods. Some are shaded red, some are shaded green. The ones that are shaded red in that time period were exceptional losers compared to the other members of the Dow, and the ones that were in green were ones that were exceptional winners over that same look-back period. So a way to highlight the difference between very strong and very weak compared to the population of the Dow. And then the furthest to the right is a set of NDXs, or indexes, and this looks at 10-day, 1 month, 3 months, 6 months, and 12 months. And most of these are scored on a scale of 0 to 100, but some of these, you'll notice a lot of them, are color-coded red. And so anytime one of these indexes is in the negative or is greater than 100, it's going to be color-coded. So those that are below, that are 0 or below, those are going to be exceptionally oversold according to the NDX. And so we highlight those as a way to bring our attention to an extreme move. And if any of these had been over 100, then they would have been color-coded green, the same shade that you see in some of these other sections. So what we want to do now is examine what the NDX means, how it's computed, and what these specific numbers mean, and why we care about them. But what I want you to notice is that some of them are bigger than others. For instance, we're going to look at 3M, and we're going to pull over to the 10-day NDX. We like the 10-day NDX for swing trading, and that scores minus 75. In fact, that's the worst score in the entire stack. And Microsoft, which was a percent winner on Friday, scores a 92, so it's almost 100. So that's the largest difference between. We're going to see what those look like in charts here in a minute. It's important to note here that that previous Friday featured an enormous sell-off in the Dow. It was down over 300 points on a Friday after a pretty good run-up in January of 2014 so far, and this was a sudden system shock. And that explains why, based on the market effect, a lot of these symbols in the Dow had broken out to new lows, and that's what a score of 0 or less means. That when you look at the trading period or the look-back period, if it closes outside of the previous look-back period's high or low, then you're going to get an extreme reading, and that tells you something important may have just happened in the market. So we use this page to pull together a bunch of different ideas, and one of the things I look at then is the NDX. We're figuring out where today's close is compared to the previous highs and lows of the look-back period in question. All right, so let's go a little deeper. Okay, so the first thing we want to look at is Williams percent R, an oscillator. and it's a popular measure of overbought or oversold. I think more people probably use stochastics than Williams percent R. I can't prove that. It's a little more complex. But it was invented by Larry Williams and is a very powerful tool. It's I commonly use this on a 10-day period. It's the default settings in most chart packages are 14 days, like a lot of technical analysis. It's scored on a scale of 0 to minus 100. That's you cannot get a reading higher than 0 or a reading lower than minus 100. And if you perform the computations and you see a score between 0 and minus 20, it's considered overbought. A score between minus 80 and minus 100 is considered to be oversold. The general advice in most like chart schools and technical advisors is that you can't use the indicator itself as a trigger, that it needs price confirmation to confirm that the setup is taking place. It's uncanny in its ability to anticipate turning points when used on a 10-day period. And the formula is computed in the following way. You take the highest high of the look back period, which includes today, and subtract today's close and divide that by the difference between the highest high of the look back period and the lowest low of the look back period, and then multiply that by a score of negative 100. That will has to give you a score between 0 and minus 100. Again, between minus 20 and above is overbought, minus 180 and below is oversold. Now that can be very useful. So let's take a look at some SPY charts here. And we've got the Williams percent R indicator down here at the bottom, and I've highlighted when it's changed state from oversold back to normal. Normal would be between minus 20 and minus 80. And then when it went from overbought to oversold. So let's see what's happening here. Now this one is, let's start with this one right here. It was in a period of oversold for 5 or 6 days, and then it changed state and then started to come back into normal. It went all the way to oversold. And in that time, price in the S&P went from 128 to 140, so a 12-point move, almost a 10% move in 9 days. Very tradable. Now you notice this dark shaded area is blue. That means its price was under the 200-day moving average, which explains why I've classified that as a bear market. And so this is a case where we had significant sell-offs, and then here it found a counter trend rally when it went from oversold all the way up to overbought. The next time it was oversold, it went from here about 132 all the way up to 138 when it left the overbought condition. So again, another pretty good alert to a change in price that's in your favor. Now it doesn't always happen that way. Here's one where it had sold off for 7 or 8 days. It was near a 10-day low, and then a little bit of price action moving in its favor got it out of oversold, but there was no follow through in this bear market, and instead of following through after this doji, continued to sell off. And so if you use this indicator, this oscillator, you have to recognize whether you would be trading with or against the primary trend. In this case, the primary trend is down. That's why signals like here in February and then late February can be powerful, because it talks about a resumption of the trend in the direction of the primary trend. If you had taken this as a signal and wanted to frame a trade, you might have entered here, but after 2 days of no follow through and a third day of sell off, which then made a new low, that would be an indication of a return to the primary trend, and you might have been able to should have been able to get a hold of this trend all the way down here to 128. So that's what Williams percent R looks like. It tends to fluctuate between overbought and oversold. When it's in the primary trend like it is here where it's down, it's not unusual to see it get oversold and remain oversold for extended periods of time. All right, let's move on. Now what I want to do is talk about Williams percent R and compare it to what we call the 10-day NDX, and see why we developed a variation of this indicator. There are two problems that we have with percent %R. The first one, it's not really a problem, but it isn't as definitive as it could be. It uses current day data and the previous 9 days of data to come up with a 10-day Williams percent %R. So if I had this particular price pattern on daily candlesticks, I would have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So I'm going from day 0 to day -9. And what that means is, on the positive side, when you use today's low as part of the calculating the lowest low of the look back period, if it closed right at the low, you would have a score of -100. In this one, we've shown a big red candle down, which made a new 10-day low, and it closed at the low, and so we're almost at the low. So it's probably about -99 by visual inspection. You would not have any indication that what we had today was a breakdown, and a significant breakdown compared to the previous 10-day trading range. All you know is that for the most current 10 days, you're near the bottom of that, which is good information, but it doesn't distinguish between a lower close in the current trading box versus a breakdown of that box, which might signal a new significant move lower. The second thing is that the readings are not intuitive. When the high score is 0 and the worst score is -100, it just doesn't feel right to me. It's hard to think of that intuitively. A more intuitive reading would be something from 0 to 100, where 100 is good and 0 is bad. And so that lack of intuitive scoring feels problematic to me. It can be overcome, but it can be a little irritating. Now let's compare the same 10 days worth of data under the 10-day NDX, which makes the following changes. It uses the previous 10 days of data, days -1 to day -10, and then compares the close of the 0 day against the previous 10-day trading range of high to low. So what that means is today's price data is outside of the framework that computes the scale of 0 to 100. It also means that when you have a breakdown below the previous 10-day low that closes lower, that you're going to have a score that is less than 0. It doesn't keep expanding to follow your price. The added value of that is now, when you have a negative number and you're looking at 30 or 40 or 1,000 symbols in your stack, you can sort by that column, and the ones that have the lowest reading are going to be the ones that have the largest relative breakdown compared to their previous look back period. And you might want to know which things have cratered the most or rocketed up the most if you had a breakout in the higher direction. The readings feel more intuitive to me on a scale of 0 to 100 instead of 0 to -100. And most importantly to me, that the extreme moves of today are highlighted as I just described, because now when you close at a new 10-day low or close below the previous 10-day low, you're going to have readings below 0, and the size of that reading is going to tell you the relative magnitude of that reading. And so we'll see some examples. So when you're looking for a quick way to get a lot of information from a single number, the 10-day NDX has certain advantages when compared to percent %R. So let's take a look at symbol 3M, and that's the one we saw was actually a score of -75 when we looked at the daily report. And we're going to compare Williams percent %R with the 10-day NDX. So Williams percent %R is the blue box, and it is scored from 0 to -100. So the blue box represents 10 days of look back, including today, the 0 day, and it finds the highest high and gives that a score of 0, and then finds the lowest low, which happened to be the close in 3M, and gives that a score of -100. So 3M in the Williams percent %R world would have a score of -100. Now, in fact, if it had closed anywhere from 133.75 down to 130.22, it would have received a score of -100 if it had closed at the low of the day, simply because of the way the indicator is constructed. So you wouldn't know just by looking at a score of minus 100 that there is a huge breakdown. All you would know is that it closed at the 10-day low. Now, if we look at the 10-day NDX, what we do is we start with the minus 1 day and go back to minus 10. We find the highest high and the lowest low, and we set that equal to 100 and then to 0. And then on today's price action, we have this huge sell-off and a close far outside that box. And then when we compute that formula, it comes out to a minus 75. Now, what minus 75 really means is that the size of the breakdown compared to the previous 10-day range was 75% of the range of the previous 10 days is how far out this thing finally closed. So the distance here from 0 to minus 75 is 3/4 of the range that it had been trading in. So that's a relatively large breakdown on a percentage basis. And so we would know that just from minus 75. So we know two things. It's oversold, and it had a dramatic breakdown when we compare it with all the other symbols that were inside the Dow 30. So we might, if we're interested in trading those targets that are in extreme conditions, and there's good reasons to do that, then the 10-day NDX gives us insights from a single number. If we were using percent R, we'd have to find all those that were oversold and then go inspect the charts, and only then will we discover which ones had closed near their 10-day low or had violently broken out to new lows. And then we would still have to compute what the relative breakdown of each one was. In this way, with 10-day NDX, you get it from a single number, you get a lot more information, and that's why we prefer that as an indicator. Conversely, this is Microsoft, and we saw that Microsoft was a 92. It was the best performer on a 10-day NDX basis in the Dow. So again, the blue box is the Williams percent R. It's scored from 0 to minus 100. And what we had in Microsoft on Friday was not a sell-off at all, but in fact a breakout, and closed at a new, almost a new 10-day high. The 10-day high, percent R is the 0 line here. So it actually comes in at a score of minus 25. Now, minus 25 means that it's in the top quarter. It's right at the 25-yard line, if you will, on its new 10-day trading range, which included today's range. You wouldn't know that today had featured a great big breakout by looking at that number, and all you would know is that it was nearly overbought. And it's not even overbought because officially, because it's not above minus 20, although you might want to know that that there was this large number, this large move outside of the previous range. Now, if we look at the 10-day NDX, we take the same close, which is this red line, and then we go back from the minus 1 to the minus 10-day. We set the highest high at 100, the lowest low at 0, and now it comes in at 92, and that's sort of officially overbought because it's above 80. And now that tells us that Microsoft has a significantly strong move, and we might be very interested in that. So you can tell how much information is packed into this just by looking at the difference between a score of 92 in Microsoft and a score of minus 75 in 3M. You get it from a single number. You get a really important insight into the nature of the beast. So again, now when we come back and look at the Dow 30 tactical summary, we can see some important things here just by looking over the NDX. The fact that most of them are flashing red on a 10-day and even on the 1-month look-back period tells us that Friday's selling was really significant for a lot of symbols, that a lot of them broke down and closed well below their previous look-back period, whether it's 10 days or 1 month. And then you can see by the negative numbers, looking at the magnitude, which ones were the most extraordinary. So you can see 3M is a minus 75. You have Johnson & Johnson a minus 61, and so on. And then these down here that are not shaded red, in fact, didn't have breakdowns. And it's not surprising to see all of these green numbers here in the look back period, that these are the ones that have had the most relative strength, and they held up pretty well in that sell-off period, much less panic. So you might want to know that going forward, especially if you're concerned how the market might respond to a negative price action of such magnitude on last Friday. That shading of reds and greens is consistent with the way that we use statistics to identify extreme conditions. And so for a population, what we will do is we'll find the average and then the standard deviation of that population, and then average plus or minus one standard deviation we'll treat as normal. If it's average plus one standard deviation between those two numbers, we'll code it as white. If it's within one standard deviation below average, we're going to code it yellow. Those that are more than one standard deviation below the population average, we shade as red. The ones that are more than one standard deviation above average, we code as green. So now when we go back and look at that daily report, when we look at the price changes over in here, the ones that are green and red are ones that exceptionally stand out. Now, what we do with the NDX is simply color code. We're not using statistics on that one. We're just using the color code to highlight ones that have made new breakouts, as indicated down here in the notes. If it's greater than 100, then it closed above the high of the look back, and we code it green. If it's less than 0, it closed below the look back, the low of the previous look back period. In the price change is where we're using the statistics to shade things that are exceptionally large or gains and losses. That just says this with a better picture. So more than one standard deviation above average, green. Then white is between one standard deviation and average, average to standard to minus one, yellow, and then more than one standard deviation below is red. Normally about 2/3 of the data lies between plus and minus one, and 1/6 of the data lies above and below those levels respectively. So now if we look at the ETF 30 tactical summary, and we can now take a look at the broad markets, global and U.S., and we see that on that day there was an awful lot of things in the red, and we notice this one over here at 132, which is XLI, which we know had been one of the strongest performing sectors in the S&P, which in turn was the strongest recent performer among the major indexes in the world, or one of the strongest ones. So a score of minus 132 would certainly get our attention. Minus 61 in XIV, the inverse volatility, gets our attention as well. And this is what that XLI looks like. And what I've done is I've marked off the 10-day NDX box here in the upper black box, scored it from 0 to 100, and then we look at Friday's price action, opened outside of that range and then closed well outside for a score of minus 132. To get an indication of the magnitude of that, and you notice that it closed at the low of the day. If we take the previous 10-day range, days minus 1 to minus 10, and then doubled that and brought it down here, if it had closed right at this price level at 50.10, it would have had a score of minus 100. In other words, it closed as far outside of the previous 10-day range as that range was wide. But it actually closed further outside, in fact, an additional 32%. So a score of minus 132 in context really provides you some relative information about the size and magnitude of that sell-off and just how poorly that closed. So that's a look at the Williams%R and its comparison to the Tortoise NDX and how we use that to help us find candidates that we're very interested in at the extremes of relative performance compared to other symbols in their peer group. So that's Ken Long from Tortoise Capital with today's quick trading lesson, and keep your powder dry and your risk measured.